Hello, my name is Tanya Casellas. I am the Senior Accountant for Net Solutions. So, what's new? There's going to be changes. That's right. Introducing the Sarbanes-Oxley Act, also known as SOX. SOX is a new law passed by Congress of the United States that imposes new regulations over accounting reporting and administration from the U.S. Securities and Exchange Commission, also known as the SEC, with the purpose of further protecting investors and shareholders from erroneous or inaccurate accounting and fraudulent activity. The Sarbanes-Oxley Act applies to all public companies, its management, and all public accounting firms. This is officially effective on July 30th, 2002. So, where did this come from anyway? Well, you remember Enron, right? And WorldCom, and Tyco, Adelphia? And after a bunch of fraudulent activities, untruthful financial statements, bankruptcies, and other unethical stuff, people finally had enough. So, what does the Sarbanes-Oxley Act want? Let's quickly review some key points here. Section 102 explains how periodic financial reports must include certifications for the following things. Accounting officers have reviewed the report. The report does not contain any untrue statements, omitted or misleading material. The financial statements fairly present the financial condition and the results in all material. Signing officers are responsible for internal controls and have evaluated such within the previous 90 days and have reported on their findings. A list of all deficiencies in the internal controls and information on any fraud that involves employees who are involved with internal activities. Any significant changes in internal controls or related factors that could have a negative impact. Please remember that organizations may not attempt to avoid these requirements by reincorporating their activities or transferring their activities outside the United States. No cheating. Section 401. Financial statements are required to be accurate and presented without any errors or admit to state material information. These financial statements shall also include all materials off balance sheet liabilities, obligations, or transactions. The Commission is required to study and report on the extent of off-balance transactions. The Commission is also required to determine whether generally accepted accounting principles or other regulations result in open and meaningful reporting by issuers. Talk about transparency. Section 404. Issuers are required to publish information in their annual reports concerning the scope, adequacy, and effectiveness of the internal control structure and procedures for financial reporting. The registered accounting firm shall, in the same report, attest to and report the assessment on the effectiveness of the internal control structure and procedures. Section 409. Issuers are required to disclose to the public on an urgent basis information on material changes in their financial conditions or operations. These disclosures are to be presented in terms that are easy to understand, supported by trend and qualitative graphic representation. We better be good or else Section 802. This section imposes penalties of fines and or up to 20 years imprisonment for altering, destroying, mutilating, concealing, or falsifying records, documents, or tangible objects with the intent to obstruct, impede, or influence a legal investigation. Also imposes penalties of fines and or imprisonment up to 10 years on any accountant who knowingly and willfully violates the requirements of maintenance of all audit or review papers for a period of 5 years. So, what are the next steps to take? To be continued. Please watch Part 2.
Created using Powtoon.